In our previous class, we talk about trending market. That is one of the example of market structure. The second example of market structure is ringing market. So this is an example of ringing market. First of all, to identify a ringing market is the candlesticks when the candlestick keep on making equal higher the higher high above just high and the lower low is not above the previous low. That's what we call a ringing market. And let me show you another type of ringing market. Let me show you another example. This is another example of ringing market. You see the thing keep on making the same higher higher high higher high higher low higher high before it break the 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 boundary there, before it break the resistance. So after identifying this, I'm going to teach you how to trade the ringing market. First of all, if you want to trade the ringing market, we have two ways of trading the ringing market. So the first way I'm going to teach you, that is the way you can use to trade the ringing market, but it's going to take you a lot of time before you get a profit in this strategy. So if you want to place a trade in the ringing market, you will come to the support of the market of the chart. So this is where you see your support, this line here, this horizontal line here. Let me change the color of the line so you can see it very well. This is the support line here. This red line here is the support line of the support, and let me draw the resistance. So in the previous market, this resistance was touched multiple times. That is why I call it a strong resistance. In this ringing market, some traders actually trade the ringing market and some leave it because it's little bit confusing. So I'm going to teach you how to trade it. Firstly, I'll teach you how to trade it with candlestick pattern. Then in our further class, I'm going to teach you how to trade it with chart pattern. So if once you see this ringing market, that's why I say you have to know the market structure before you start placing a trade, because you may see something in bullish range, you can place your trade, it stop you out from the market. So you have to identify the ranging market. So in this condition now, this is what we call bullish ranging. a bullish range because it starts from the downtrend. It starts from the downtrend, range, and break out the resistance level and keep on moving up. It's not that this is bullish range. This normally occur in a chart, but there's a time that you are going to see this ringing market. It will start from the downside, move up, keep on ranging and fall. So it's not by force that it's going to break out this resistance level. It may reverse back to the support level to break it out. The first way of how to trade candlestick, this ranging market, is when the candlestick touch your support. This your support, another support, your resistance level. So when the candlestick touch your resistance level or touch your support, another resistance level. So all these things is where you are going to take notes. You keep on, your eyes should be on the trade so that the market is not going to left you away. But some traders don't usually trade this ringing market because it bring a lot of confusion in the market. After the candlestick starts ringing, you take note of the support level. You take note of the support level. So if you want to place a trade, you look at your support level or your resistance. Look at it and identify the candle, the candlestick pattern that formed there. So in this first place, this is a morning star. That is a morning star. So make sure you identify the candle and it's formed with a good bullish momentum candle. That white candle there. So that is going to be your reason, your entry reason for placing a trade in the ringing market. So before you place a trade, make sure you have a good reason that will make you to place a trade. Because you can't come out and look at the chart, you say, and this is a momentum candle, so I have to place a trade there. That my teacher teach me that if I see a bullish momentum candle, I should place a trade, or if I see a bearish momentum candle, I should short the market. No, it's not like that. You have to look at it, get a reason, ask yourself, is this the reason? Is it in my rule? Did I read this thing when did they teach me? Did any teacher teach me this strategy? You have to identify all those things. That's what will convince you to place a trade. So if you want to place a trade after that bullish momentum candle, you pick your tools for longing the market. You pick your tools there. Make sure your stop loss is above your support level. Above it here, so that the market cannot come and stop you out. This how many percent? I usually set my own 1-to-1 risk reward ratio. So this they stop my stop loss. I'm losing 6% of my money and and gain 6%. That is 1-to-1 risk reward ratio. We can comment. I don't know why this 6%. Yes, see it here. You see, it hits my target with that 1 to 1 risk reward ratio. It hits my target, see it here. That is why I say make sure you are not greedy in the market. I keep on saying that. Make sure you are not gambling with your money. Make sure you have a good reason for you to enter to place a trade. So let us go to another place where the candlestick touch the support level. This is another side, and the candle formed there is bullish engulfing candle. So in this pattern, you have to leave this candle to form before you place a trade. These two candle, this momentum candle here, because it engulf the bearish candle. It engulf the bearish candle. So if you want to place a trade there, make sure that that bullish engulfing candle formed. So after the formation of that bullish engulfing candle, you pick your long trade, your long tools to long the market. That is to buy the market. In futures we call it long, but in spot you buy. You click it. eh, you see it is 1 to 1 reward ratio, and it is above my support level. It is above my support level. See it. It's above my support level, and it give me a good risk reward ratio. So far you have identified your resistance, and you know that the market is going to touch the resistance. You can raise, you can increase your stop, your take profit, but I don't advise that, because you don't know what is going to have happen in the future. You don't know whether it will start reversing from there to the downward. You don't know whether the market is going to reverse from after forming this higher high here. From here it will reverse and go down. Some people usually take that risk, but for me I always use 1 to 1 risk reward to discipline myself. So in this cryptocurrency of 18, make sure you have a rule that guide you. It's just like a commandment. Make sure you keep all those commandments that you made for yourself. If not, you are going to lose all your money in the crypto space. So let me show you the bearish example of how to short your market. Hmm. This is where I'm going to show you the bearish example when the market touch the support, the resistance level and go down. So after the touch of this resistance level here, you see the formation of candlestick pattern formed there is the tweezer top. The tweezer top, these two red and black candle, what formed there is a tweezer top. So after the formation of that tweezer top, you know that the tweezer top occur in an trend, it occur in the oversold of the market. So after the formation of that user top, the next candle forming is going to be a bearish candle. The next candle forming there is going to be a bearish candle. So after the formation of that candle, you pick your short tools. You pick your short tools to short the market. After the formation of these two tweezer top, these two candle there, you pick your short to short the market. This is where you can do 2 to 1 risk reward ratio, because the candle formed there is not a it's you know that it's going to hit your target. So after placing your short tools here, you are going to make a profit of 5%, 5.58%. Divide the 5.58% into 2, so you know where you keep your stop loss. If you divide it into 2, you are going to get like 2.5 something something. So you bring down your stop loss to 2 point something. You bring it down to 2 point something. So this is where you are going to make a massive gain. You are risking 2.73% of your money, and to gain 5.58%. So this is how you place a trade in a ringing market. And another way of placing a trade in a ringing market is waiting for the breakout. If you can't place a trade in this zone here, if you can't place a trade in this zone here, not this zone, you wait for the breakout of that zone. After waiting for the breakout of the zone here in this place, after waiting now for the breakout of the zone, you wait for the candle to retest that resistance level, that resistance line. You wait for the candlestick to retest it. Like after breaking this thing through here, you see a retest. It retrace back to touch that resistance line there. Let me show you with these tools. After the breakout here, like from here, that is breakout. After the breakout here, it retests before it move way up, before it skyrockets. Let me change that line, let you see it very well. So after the breakout, it retests back before the market move up. So in this pattern, after the breakout, make sure you didn't place a trade, because that is going to confuse you. Make sure you didn't place a trade. Like after this breakout, you allow the market, the thing may be out with a big momentum candle like this. Let me say the candle may be like this. As example of candle may be like the candle may be big like this. So after the formation of this candle, don't place a trade. Don't ever try it. Don't ever. Because when you are going to place a trade, from there the candle may start retracing back. So in this retracement, it is not going to hit that resistance level. So you are going to look for your previous your previous support. That means your previous support level where the candlestick is going to retrace back. So after looking at that, after the formation of that retracement, you look for a candlestick pattern that will convince you to place a trade. After the pullback of after the retesting of the this thing, the resistance level, you know that this pattern formed here is hammer. This candlestick pattern that formed here is a hammer. This white one that retest the resistance level. That is this one here. Wait, I'm coming. This one here in that resistance level. This one here that form. This white bullish candle is a hammer. So after the formation of that hammer, this is your condition for you placing a trade. This is your condition. So you pick your long tools to long the market. Pick your long tools to long the market. Remember your one-to-one risk reward. So this this is your previous sup- that is your previous support level. So you make sure that your stop loss is above it, so that the market cannot just come and stop you out from the market. Make sure it is above your support. That is how many percent? 8 to get 8%. Let me 8% is your 8% here. You see the thing hit your target. This is how you will make your cool money, by disciplining yourself. Don't be greedy in the market. So I'm going to show you the other other type of the ringing market. The where the ringing market fails, where it fails. So it's not that if you see this ringing market from the this thing, from moving an uptrend, start forming ringing market, you will now say the market is going to continue the way up. It's not working like that. So I'm going to show you another example of that. This is another example of the ringing market. This is where it fails, because it's from the downtrend, it enter inside the zone, keep on ringing, instead of moving the way down, move, but with the strong belief that the bullish, I mean the bearish, are trying to win the market, to move the market upward here. So that is why I said you don't have to place a trade, or if you make sure that you have a good strategy for you placing a trade in this ringing market. So the best way for you to place a trade as a beginner in this ringing market is to wait for the breakout. After waiting for the breakout, you wait for a retest of the you wait for retest of the market, of the resistance level. So you can call this pullback, because in the previous resistance, that is a resistance level. In the previous market, I mean, that is the resistance level. So you can call it pullback. It's not by force that it's going to touch this your present resistance here. It's not by force. So that's why I say you have to draw your trend line, your support and resistance line. So I've not teach you that. I'm still going to teach you. So after teaching you that, you you combine all those things that I teach you to identify all that. So please keep on practicing. Be practicing, please. So in this formation here now, in this ringing market here now, for you to place a trade, for me, as seeing this formation here, this is not a candlestick pattern that's convince me of placing a trade there. So as that formation form, I'm not going to place a trade because it's not a reason for me to enter a market or enter the market, because the market may push right down because I don't know this formation. This is not a candlestick pattern. It's any pattern. You can't call it inside bar because this um bearish candle is not is too big for you to call it an inside bar. So after the formation, I'll leave the candle to retest this my level. I'll leave the candle to retest this my resistance level. So after the retesting of my resistance level, this is the retest. This is the bullish the bullish engulfing cycling like this. This is a bullish engulfing pattern, candlestick pattern. No, not that one. So after the formation of that candle, I will short the market. I'll short the market 1-to-1 risk reward. So you can take your profit like this because it is above your previous support. This is how to trade a ringing market. The same thing in for you to long the market, that is for you to buy. So the other way of trading this ringing market is for you to draw your trend line, your support and resistance trend line. Let me pick my trend line tools for you to show you that. You pick your tools, you draw it from here up. This is a strategy I create for myself. Nobody teach me this. I'm just trying to teach you. You create it up. After drawing this support and resistance, let me color the resistance. Let me say green color, and the support should be red. So the support and resistance, after the formation of that, after drawing your trend line, you wait for a breakout there. You wait for a breakout. This is the breakout. That bearish candle there. This bearish candle here. This is a breakout. This black candle. That is a breakout. So after the breakout, you wait for a confirmation candle that is going to tell you that the market is moving in downward, that the market is going to reverse. Please take note. Make sure the candle break your support level, that is that red line. That is your first condition. Your second condition, make sure you see a candlestick pattern that is going to tell you that the market is going to move in a downtrend. So after the formation of that, this is the candle that tell you that the market is going to move in a downward. This one, that's white candle there. So this is an inverted hammer. It occur in an uptrend. So you, after the formation of this candle, you place a trade, you short the market. You short the market with your one-to-one risk reward. You see what I'm talking about. With your one-to-one risk reward, you short the market. The same thing applicable if you want to short the market. You draw your support and resistance. Let me draw it again. Let me give you another example. Some do not retest, and if you don't retest, you don't place a trade. So after drawing this your support and resistance here, you see it break the resistance there. It break it. So after breaking the resistance, you see no retest. Leave it. Don't place a trade there to long the market. Just leave it, let it go. Don't be greedy. Don't FOMO. Leave the market to go. So after you leave the market, you are still going to see another trading opportunity for you to trade this market. So another trading opportunity is the candle touching your support line here. See where the candle touch your support line. This is what we call inside bar. This bullish and bearish candle. Those two, that is what we call inside bar. So after the formation of that inside bar, you can now short the market, because this pattern, this pattern that I draw here don't work all the time. So you can even use the pattern when the market is trending up, it's an uptrend or downtrend. So but I don't usually use it. That is the first pattern I use to draw my analysis. So the pattern failed me sometimes. Sometimes I make profit with it, but I usually fail with that pattern. So you can take the strategy, modify it by yourself. You create a rule beside it so you can use it and trade. So after the breakout of this our resistance level here, you see, you don't have any entry reason. Don't enter the market. Don't buy anything. Don't long the market. You wait for this candle to touch your resistance level. and form and show you a good reason for you to enter the market. So the reason of me entering this market is the formation of this harami pattern, that is the inside bar. Because this candle here, this black candle here, is inside the white one. So after the formation, now I place my trade with my 1-to-1 risk reward. I enter the market with my 1-to-1 risk reward. You see the thing hit my target. You see it hit my target. So that is how you trade the candlestick pattern in a ringing market.